Let's bring in CBS News contributor JD Durkin. JD, always good to see you, my friend. So we just got a couple of reports out at 8:30, including the July personal consumption expenditures, or the PCE index. What do you make of the numbers?
Yeah, it's interesting. I think overall here, Vlad, running warmer than expected, not necessarily probably what the average American at home wants to hear, and certainly not what market participants here in the stock market want to hear. We came into this morning's session here on Wall Street expecting stocks to open flat or positive. Instead, it looks like we've got a fair bit of red across the board. It's a really important gauge of inflation. We get several of these, of course, over the course of the month here, Vlad. This one in particular is the most holistic view of inflation. This is the Fed's favorite gauge of inflation, showing us how fast the cost of everyday living is climbing. We get headline PCE, and then you strip away some of the really volatile elements, how much money you spend on gas and groceries. Those things can swing in a pretty volatile way month to month. That's called core PCE. And they're both running hotter than the Fed wants to see, 3.7% and 3.3% respectively. The Fed's clearly stated goal under Jerome Powell and now new Fed Chairman Kevin Warsh is 2%. And stocks are down this morning, likely because this makes it a lot less likely that the Fed can cut interest rates. Amazing to me. We came into 2026. We were expecting some degree of interest rate cuts this year. That narrative has shifted with every hotter than expected inflation print. Market participants now expecting an interest rate hike on the table, at least for the month of December. And so that narrative has shifted quite a bit. And we'll hear a lot more from Fed Chairman Kevin Warsh during his highly anticipated Jackson Hole address coming up later on this week.
Wow, now we're expecting a possible hike. Okay, so you just broke down PCE. Let's go to another acronym that a lot of people remember from Econ 101. GDP. The government just released its second revised GDP report for the second quarter. What stood out to you?
Yeah, we love acronyms here on Wall Street. Let me be clear. Revised GDP, of course, gross domestic product, the value of all of the goods, all of the services made by a country. Today was the second look at the second quarter. So what was our GDP in the U.S. for the months of April, May, and June? 1.5%. Pretty strong, but it does show us that the annualized growth rate of GDP is actually slowing. No need to sound the alarm bells. We're certainly not in recession territory, but we really like to see what's called a Goldilocks zone. GDP coming in somewhere between 2 to 3%. That is healthy growth. Q1's number, I believe, was 2.1%, so came in a bit lighter than what we've seen from earlier in the year. But what really stood out to me in this report, consumer spending. Where is the money coming from? Americans swiping the plastic, going on to credit card debt. That is largely what's keeping the engine of the U.S. economy running right now.
All right, JD Durkin for us. JD, as always, thank you.